Welcome to this video which covers Extract 5 Structural Issues in the Zambian Economy of the OCR F58 2016 stimulus. What this whole extract is going to argue is that Zambia's macroeconomic performance has benefited not just from the increase in global commodity prices, which of course recently reversed. It's also undergone a shift in the composition of its aggregate demand, which may enable it to increase long-run economic growth. Private sector investment is now much more important and is replaced by a dependence on public sector investment and public and private sector consumption. This is likely to have a favourable effect on the supply side performance of the economy. Reforms to the supply side of the economy are seen by some as a key to promoting long-run economic growth in Zambia. If that paragraph sounds familiar, you'd be for the eagle-eared, if you like, of those of you listening, then that's because it's from the introduction. Remember, the introduction to the stimulus gives us a real clue about where they're going. So, let's have a look at the Extract 5 material. The first thing it says is that the Zambian economy has had stable economic growth, which was less affected by the global economic and financial crisis. Well, that's partly because the global economic and financial crisis affected most those economies which are really integrated into world financial markets. Zambia's, frankly, just too much of a developing economy to be that integrated. And in any case, China put in a huge fiscal stimulus after financial crisis, which kept it going, and as we know, Zambia is more dependent on those commodity buyers like China. The key point to bear in mind is that 6% growth on average over the last 3 years of the stimulus data period is pretty good. But we know that since the stimulus was written, things have changed rather dramatically, and the medium-term outlook for Zambia is not so rosy because China is slowing down and commodity prices haven't yet picked up. Remember, they collapsed after the time. So if you have a look at the growth of Zambia during the period the extract covers, you can see it was a sort of bounce back from the financial crisis, reasonably rosy, and although of course from this data you can see not quite as hot as it was in the few years before the financial crisis, but in all the years from the period in the stimulus, Zambian growth is lower, and indeed can you see in 2015 and then forecast through 2016 and 2017, it's not only lower than it has been, but predicted to be lower than other sub-Saharan African countries. The next bit in the stimulus is the fact that inflation has fallen from around 10% to 6.5% in 2013. That's great, that's lovely, very nice low inflation you can see through 2014 as well in Zambia, but then recently it's really gone up to nearly 20%, mainly as a result of the depreciation in the kwacha. So whilst they have done really well, Zambia, in the 21st century, right now inflation is very high. And just a quick theoretical note, you must understand that inflation causes a depreciation of the currency, and a depreciation causes inflation. You're right if you think that sounds circular. It can easily entrench itself into a rather nasty spiral of inflation and falling currency value. In this case, in the case of Zambia, following the commodity price collapse, the kwacha collapsed, and then they had inflation. So it's more that inflation has been caused by the depreciation of the currency than that the depreciation of the currency has caused inflation. What are the problems of inflation? Just to recap some theoretical points. Well, frankly, a little bit of inflation is not a big deal, but when it starts rising, it can easily get out of control, and high rising accelerating inflation, known as hyperinflation, is not a little bit bad, it's catastrophic. It can cause the complete collapse of market economy. So, cost of inflation. 1. The price mechanism. Inflation distorts the working of the price mechanism because prices are fluctuating. This means we can't measure things properly. It can have profound effects on the efficiency of a market economy. Secondly, uncertainty. It causes uncertainty about price and future value of products and reduces investment. And because it changes domestic prices relative to foreign ones, it adds a cost to trade. It also, number 3, arbitrarily redistributes from savers to borrowers. It means it punishes saving and allows imprudent borrowing behaviour. It also redistributes from people on fixed incomes, for example, the poor without any union power in the countryside. And number 4, it causes menu costs and shoe leather costs. Inflation causes a cost to business who have to constantly change their prices. Imagine changing your menu all the time. And it also creates a cost that you have to be more careful in the way that you manage your assets and your wealth, because you have to you can't keep things in liquid money because of the loss because of inflation. Imagine having to go to the bank all the time to move your money in and out of different assets. That's the shoe leather cost. Okay, and the final bit in the preamble to this extract 5 is that the tripling of global copper prices from 2009 had a significant impact on the production of the mining sector. Yes, we know that. We know that copper is vital for Zambian growth because it's such a huge component of their exports, and export revenues are very, very important to a small developing country like Zambia. If you look at the figures later on in this extract on the components of aggregate demand, you can see that in 2001 it had a whopping trade deficit, and this great copper boom has managed to turn that around, so that by the period studied in the extract, 2011, 2012, 2013, Zambia runs a nice trade surplus thanks to the value of its copper. But we know that that has changed. Have a look here at copper prices. World copper prices, they did triple between 2009 and 2011, but that's partly because in 2009 world copper prices were really, really low as a result of a little blip in the world financial crisis. They pick up quite nicely, and Zambia enjoys some nice high prices in the period of the extract, but since then, look, things have changed. The copper price has collapsed right down here, and this is no good at all for Zambia. Right, just a reminder now about what are the main components of growth in actual output. They are the components of aggregate demand, consumer spending, the investment, government spending, and net trade. C plus I plus G plus X minus M. And let's recap at what an increase in aggregate demand would look like and what short-run growth would look like. You see, aggregate demand increases. That means a movement along the short-run aggregate supply curve, and that creates growth in the short run. If that is beyond full employment, as I've shown in this graph here, that would create an inflationary gap. In other words, this growth would not be sustainable in a sense of long run ceteris paribus, because we've gone beyond the normal full employment level of the economy. Of course, that's only because where I started in the graph. If we started down here in recession, you boosted aggregate demand, then that would be fine. Long run growth, on the other hand, is all about the supply side. It is about LRAS shifting to the right. In other words, you cannot have growth in the long run just by boosting aggregate demand. You need to increase the capacity of the economy too. Pretty simple diagram just to remind you that LRAS has to shift to the right in order for there to be long run growth. That happens because of an increase in the quantity or quality of the factors of production. And remember that the increase in the quality of the factor of production, would be measured by output per unit input, and that's known as productivity. So productivity is the key to growth. If you put those two graphs together that I'd just done, and you had growth in demand and supply, then you'd have the happy situation of non-inflationary growth in your economy. So, let's have a look at the data that they give us in Extract 5. Here is the table in Extract 5 presented for you in a colour-coded way to help you understand that this table is all about C, private consumption, consumer spending. C, I, gross capital formation as GDFCF, component of I, the main bit of I in our equation. They've shoved in public and private investment in this, different things, but both strictly speaking counted as I in the accounts. G, government current spending, going down as public consumption. in this graph. That's just G there in the dark blue, and the green section here, that's your external sector, net trade, export minus imports. C plus I plus G plus X minus M. And on the data, what they're showing us is how big these different components of GDP are as a proportion of GDP. And you can see the big story here is that it has shrunk. Consumer consumption by the private sector has shrunk as a proportion, and that's mainly because of a rise in investment and a rise in government consumption and exports. Let's have a look at investment briefly. I can leave you to draw your own conclusions, but the main story here is that the public investment, that's government investment, from 2001 to 2009 decreased. So on the one hand, you might say that's quite good because it shows there's been privatisation or denationalisation and less sort of involvement by the government in the economy. On the other hand, you can see that that might mean a lack of investment in infrastructure, which could be quite worrying. Private investment, on the other hand, has increased a lot between 2001 and 2009. In the later period, you can see that private investment stalls is a big problem. This is partly because of Dutch disease, I imagine. Local private investment in particular in anything but mining will have suffered, whereas the government started splurging again in this period, slightly unhelpfully. Overall, therefore, investment growth slowed from 14.7% to 4.6 and 6.5% between 2010 and 2012, and that's meant that it has been less of a contribution to growth, and indeed in 2011 it was a negative contribution to growth, the lack of or the shrinkage in private investment. Remember, and here's the key point, investment is triple powered because it boosts AD, so it increases short-run growth in actual output. It boosts AS because it increases the capacity of the economy, and it embodies technology, so it means that the quality of your factor of production, your capital is better because every time you invest you get the latest stuff, and the latest stuff has the best technology. So it increases short-run growth and long-run growth twice over. All this data has meant it's been pretty stressful for a minute, so here's a cute picture. Right, back at the data, let's have a look at consumption. Well, private consumption, consumer spending, there it is. It shrinks as a proportion of GDP because in 2001 there was very little anything else. But since then, there's been an export boom and investment in particularly those export industries. It still is, in fact, a really important driver of growth in the economy, as it is in all economies, in fact. The government consumption figure, G, is slightly worrying in as much as that it doesn't contribute much to growth, but it is quite a large proportion of GDP. Some of the figures that I've seen suggest that a lot of that is emoluments, in other words, making sure that the ruling elite and government are well looked after. This is a slight worry because it looks like corruption. There it is, highlighted for you. Even though government investment strictly counts as I, not G, I thought I'd highlight that a little bit alongside government spending, because in terms of the government's budget and what it has to spend, both of these components are important. Right, going on to the external sector, X minus M, or the balance of trade. What we can see is that Zambia imports an awful lot, and because it imports an awful lot, the contribution to real GDP growth of X minus M can be negative. Of course, Zambia imports a lot because it needs capital goods, it needs oil, and one or two more pleasant consumer goods, you'd imagine. The thing that's been making that affordable in the recent past is the copper prices and their exports of copper. Now copper prices have collapsed and the kwacha has collapsed. Imports will be much more expensive, and exports will be doing worse and earning less revenue. And assuming that these things are not very demand elastic, exports and imports, that means that the Marshall-Lerner condition will not have been met, and so the balance of trade is just going to get worse and worse despite the depreciation. So what do all these aggregate demand things add up to? Well, they add up to a picture that, at least when the stimulus was written, things were looking okay in terms of balanced growth in Zambia, but slight worry of underinvestment. That might well be a Dutch disease effect, that there really wasn't much call for investment in things other than copper, and copper investment really came from outside through FDI and was probably slowing a little bit. In any case, we don't want that now because it just contributes to overcapacity. But the government hasn't invested enough, and it certainly didn't invest in power generation since 1977 and the completion of the Kariba Dam. So, bit worrying. But growth generally is a good thing. Remember that growth gives higher living standards, generates employment. It can provide tax revenues for the government to provide infrastructure and boost innovation, and therefore further growth. And I think it's worth saying here again that although I've been quite down on Zambia, it is absolutely true that it has been one of the relative success stories of Africa, with pretty good growth over the last 15 years, and that's largely to do with a relatively low level of corruption and some pretty good policies by the standards of the continent. But just be cautious in saying Zambia's good growth until recently will have resulted in much higher living standards. Those growth figures have to be considered against the fact that most of the money generated has been in the Lusaka copper belt, so it's not being widely spread amongst the population, and secondly that population growth is so high in Zambia that growth per capita hasn't been that great. I think I've given you some figures on that, but the average age in Zambia is something like 16.8, which just shows you what a boom in births there have been. Is growth the same thing as development? Is growth always good, or is it good enough? Well, there is the problem of distribution, whether it's evenly spread. There's also the problem of growth creating negative externalities, particularly environmental ones. And there may well be problems of sustainability. And remember, there's always marks in the F585 exam for going green, for mentioning green issues, and talking about sustainable development as well. So really, really think about how you can put that in as an eval point in just about every essay. So, just to remind you, long-run growth is about increasing potential output, shifts in LRAS, and how does Zambia look on that score? Well, they need to do some more investment and infrastructure. The private sector development reform programme is one way in which the government has discussed how things need to change. It says that there needs to be more investment from the private sector because that's an absolute key to growth. Investment, as I said to you, was triple powered. Diversification would be important for the resilience of the economy, mentioned here. Why? Because as we have seen, as it has transpired, that they were over-reliant on copper, and now the economy looks really, really bad. And if they'd been invested in more than just copper, then perhaps now the kwacha devalued, they might be really benefiting and trading very well. But as it happens, Dutch disease has ruled the roost. And as the theory says, development theory says, you need good institutions for you to have growth. You need your banks to be good. You need the business climate to be good. You need bureaucracy to be low. And all of this stuff is really not that great in Zambia. As I said, maybe quite good for some parts of, not that bad for sub-Saharan Africa, but not good either. For example, when I was looking at the last extract in remittances, I was looking up the cost of sending money from one country to another, and sending it from South Africa to Zambia costs much more than sending it from London to Zambia or London to South Africa, just indicating the kind of bureaucratic hoops that are around in countries like that. Don't underestimate these problems, both physical, bad roads, bad communications like that, as well as economic and financial, like the lack of a properly developed stock market. Here's some data from the World Bank about the kind of ideas that they're looking at in Zambia. to improve development. They are currently going through a thing called Vision 2030 and the 6th National Development Plan. It's about broad-based wealth and job creation through technical advancement, inclusive growth, fostering competitive and outward-oriented economy. So they want export-led growth, they want it to be inclusive, which means they want it to not cause more inequality, and they want to reduce poverty and reach middle income status. Well, they've made it one step because they're now in lower middle income status, as you know. They understand that they've got to reduce the cost of doing business, improve competitiveness, and do something about the rural economy, which, with all this talk of copper, we forget that the vast majority of Zambians are employed in agriculture. The rural economy is really important to most people's livelihoods, and they could improve that to a great degree. So, what does the stimulus say about the lack of supply-side growth? Bear in mind that the last few slides have all been talking about the supply side, things that affect LRAS. Well, they mention poor access to credit. It's very difficult for farmers and businessmen to borrow money, and they can't buy capital, can't buy tools and machines, they can't expand their little plots of land, their factories and so forth. That's terrible for growth in the economy. Poor infrastructure, I think I've mentioned. Imagine how bad it is to have bad roads, no power, no access to clean water, and that sort of stuff when it comes to trying to make a business run successfully and grow it. Excessive bureaucracy also mentioned, and regulation, licensing requirements, same sort of thing. So when you think of supply side policies, think of all the ways you could remove some of these constraints and problems that the Zambian economy suffers from. And the really glaring omission in this stimulus is a lack of mentioning of the power crisis in Zambia, because it's a really obvious supply side problem. I mean, it couldn't be more obviously close to the word supply side that there's a lack of supply of electricity in Zambia. There are these rolling blackouts, and if you're a firm, you're not able to rely on the electricity. Look at the way that demand outstrips supply. It's going to be very difficult to produce, and it'll be very difficult to plan for growth. As 2030 vision highlights, energy is one of the most important driving forces behind the development of an economy, as it cuts across most economic and social activities. Yes, and in development terms, remember that if you've not got electricity, your quality of life's not very good, especially if it's dark. The 6th National Development Plan also stresses that poor and inadequate infrastructure remains the major constraint to economic development and poverty reduction. The major constraint. 40 years nearly of no real investment in new dams in a country which is 95% hydroelectric reliant. Very, very worrying. Very, very worrying situation for the long run growth of the economy, because it's hampered by this power shortage. Then back to the stimulus, there's the thing about mining. It's about the Chinese coming in and investing in mining. One wonders really whether this will have changed since the copper price collapsed and the Chinese economy slowed. All this of Brazilian, South African, Chinese companies wanting to invest in Zambia, well, I'm not so sure they are going to be that keen to invest in it right now. But you could also, in your essay, say, even if they were, how good is this for Zambia? Because although investment coming in, FDI coming in, is great for the demand side of the economy and the supply side of the economy for the time being, what will it do to the Dutch disease problem we've identified? Over-specialisation in copper, not so great. What will it do to the sort of suggestion that foreign multinationals have too much power in Zambia and can extract value from the economy without paying their fair share of taxes? What does it do to the sustainability of Zambian growth when we suspect these mining companies might be environmentally unsound? So, interesting evaluation on this point, I think. Enterprise zones, I've written some things on the right here about why designating certain zones as enterprise zones. This is really where they say, go everybody and invest in this area of my country. We'll give you special tax breaks, low tax or support, or we'll spend on some infrastructure there. Might be useful. Here's some ideas about how it might be useful. I have to say, I would have thought that the free market can find out the best places to invest, but there are some issues about crowding in and the government providing infrastructure in certain clusters which could work. Thank you for listening to this video on Extract 5. The supply side growth story is particularly important in this extract, I think, and feel sure it'll come up possibly as a 20-mark question this year.